Hi everyone, welcome back to the channel. Today, we're breaking down dividend investing versus other types of investing. If you're wondering whether chasing income from dividends is better than focusing on capital growth or another strategy, keep watching, because we're diving deep into the pros and cons of each. Let's get started. First, what exactly is dividend investing? Dividend investing is a strategy where you invest in companies that regularly distribute part of their earnings to shareholders in the form of dividends. This can create a steady income stream, which might be especially attractive if you're looking for regular cash flow or planning for retirement. The key idea is to invest in established companies with a consistent track record of paying dividends. Examples include blue-chip stocks like Coca-Cola or Johnson & Johnson. For many investors, the appeal lies in the potential for both dividend income and long-term growth in the stock's value. Now let's talk about some of the benefits. Regular income. Dividend stocks provide quarterly or annual payouts which can help cover living expenses or be reinvested for compound growth. Lower volatility. Historically, dividend-paying stocks are often more stable, as they tend to be mature companies with proven profitability. Compounding returns. Reinvesting dividends over time can lead to significant compound growth, boosting your overall returns. Potential tax advantages. In many jurisdictions, qualified dividends are taxed at a lower rate than ordinary income, adding an extra layer of benefit. These factors make dividend investing particularly appealing for income-focused investors and those looking for a conservative long-term strategy. However, dividend investing does come with some potential drawbacks. Lower growth potential. Companies that pay high dividends often reinvest less in rapid growth. This means that while you get income now, the stock's capital appreciation might be slower compared to high-growth stocks. Dividend cuts. Dividends aren't guaranteed. During economic downturns or if a company's earnings falter, dividends can be reduced or suspended, impacting your cash flow. Limited diversification. Focusing solely on dividend-paying companies can limit exposure to sectors that typically reinvest earnings for growth, such as tech startups. Interest rate sensitivity. When interest rates rise, dividend stocks may lose appeal compared to bonds or other fixed-income assets, affecting their market performance. Let's compare dividend investing to other investing strategies like growth investing or index investing. Growth investing. Focus on capital appreciation through companies reinvesting earnings for expansion. Pros, potential for higher overall returns in a booming market. Cons, higher volatility, no regular cash flow. These companies often do not pay dividends. Index investing. Focus on diversification across a market index, which includes both dividend and non-dividend stocks. Pros, lower fees, broad market exposure, and simplicity. Cons, average market returns might be lower than what targeted strategies can achieve if you're skilled at stock picking. Value investing. Focus on buying undervalued stocks with the expectation that the market will correct the price. Pros can generate significant gains if the market recognizes the intrinsic value of the stock. Cons. It may take a long time for these investments to pay off, and dividends might not be a part of the equation. Historically, if you look back over the past 30 years, many dividend-focused portfolios have delivered solid, steady returns, which can be less volatile during market downturns. However, portfolios focused on growth have sometimes outpaced dividend portfolios in bull markets. The key takeaway is that your best approach depends on your personal financial goals and risk tolerance. So, how do you decide? If you're looking for consistent income, say for retirement living expenses or reinvestment for compounding, dividend investing can be very effective. On the other hand, if you're willing to tolerate higher volatility for the possibility of higher long-term capital gains, growth, or diversified index strategies, might suit you better. It's also worth considering a blended approach, where you diversify your portfolio to include both dividend-paying stocks and growth opportunities. That way, you can potentially enjoy the best of both worlds, steady income and strong capital gains. In summary, dividend investing offers a steady income and lower volatility, but with somewhat lower growth prospects and potential risks in payout stability. Meanwhile, other strategies such as growth investing can deliver faster capital gains, but often come with greater risk and no regular cash flow. Remember, every investment strategy has its pros and cons. If you found this breakdown helpful, please hit the like button, subscribe to the channel, and leave your thoughts or questions in the comments below. Let's keep the conversation going. What's your experience with dividend investing versus other strategies? Thanks for watching and happy investing. Subscribe for more investment insights.